Options trading with Robinhood, why you should not trade options using the Robinhood app. My name is David Jaffe. I am the founder of beststockstrategy.com. I graduated from an Ivy League university, worked as an investment banker for 5 years. I've completed around $5 to $10 billion worth of transactions. I'm here to help you. And the reality is that when you use Robinhood, I know that a lot of people are drawn to Robinhood because there are no commissions. But one of the big fallacies of making money in the stock market is people are scared to trade naked options. When the reality is that let me first start off. The only way that you're going to make money in the stock market consistently is by selling naked put options. That's it. Occasionally you'll sell a call option in a bear market, but the reality is the only way that you're going to make money is by selling naked put options. So there are two things you can do when you sell put options. You can either sell a naked put option or you can sell a vertical credit spread, right? The problem is that Robinhood does not allow you to sell naked put options. And naked put options are inherently much more safe than vertical credit spreads. You probably think that that's blasphemous because you've heard all of this stuff about naked put options being incredibly dangerous. But no, they're not. Actually, vertical credit spreads are incredibly dangerous. And for the reason that the reason why naked put options are way safer than vertical credit spreads, you have three reasons. The first is that you are able to collect the maximum amount of premium because you're not buying that lower price strike option. The second reason is that when you sell a naked option, it inherently limits you to manage your size. There's no way that you can sell 100 contracts on Amazon if you have a small account. When you trade a naked option, then your buying power is going to be reduced relatively substantially by every option that you trade, by every naked option that you trade. What happens when you try to sell vertical credit spreads are that human beings are inherently greedy. So when you trade vertical credit spreads, if you can trade 2 naked options, a lot of people end up trading 20 vertical credit spreads. And then yes, they will be successful on 95 out of those 100, but what happens is those 5 times that they lose money, they are going to lose very big and lose all of their returns. So for example, right? Let's say Facebook's trading at 175, it falls down to 170, you sell a naked option with a strike price of 158, all right? Then 95 out of 100 times, you're gonna make money on that trade. If in the worst case scenario, it trades to 155, then you're gonna roll that option and then it's very easy to manage. If instead you trade a vertical credit spread, so you would sell that same 158 strike, you would then buy the 150 strike, right? And then what a lot of people do is if you would sell 2 naked options, they would then sell 20 vertical credit spreads. Let's say Facebook falls to 153, it's in that no man's land. The broker will then close out your positions because you simply don't have the account size to take inventory of those 2,000 shares of Facebook. So you will end up buying Facebook at 158, 2,000 shares of it. They will close you out for a loss, and that is going to eat up all of your returns for the past 6 months. I've seen this happen numerous times. I can't even stress how dangerous vertical credit spreads are. Like, yes, I do use them on occasion because for a stock like Amazon, which is a $2,000 stock, I don't really want to sell a naked option and have my buying power reduced so much. But one key is that I do manage my size. If I'm going to sell 2 naked options on Amazon, I sell 2 vertical credit spreads, a maximum of 3. I don't do what a lot of other people do, and if they were going to sell 2, they end up selling 20. That's what's going to get you in trouble. The other thing about vertical options is that it's incredibly difficult to manage and roll a vertical option because the money that you're spending for that lower price insurance, you're essentially throwing away. So in that example that I used previously with Facebook, if you would sell the 158 strike and you would buy the 150, then let's say Facebook trades to 153 and you tried to roll it. Let's say you had the ability to roll it. If you were trading a naked option, you could simply roll forward by 3 or 4 weeks that 158 option and reduce your size or reduce the strike price all the way down to 155. With a vertical credit spread, that credit that you're receiving for rolling that option into the future is then going to have to be put into buying that lower price 150 strike again. So you're gonna have to keep the same amount of options and roll it forward, and you're gonna have to keep that same 158 strike price, whereas if you were trading naked, you would be able to easily reduce that 158 strike price all the way down to 155. But instead, with a vertical credit spread, that money that you would use to reduce the strike price from 158 to 155 is now going into having to buy that worthless 150 option. So that's pretty much it. The three reasons, or rather the main reason why you don't want to use Robinhood is because it does not allow you to trade naked options. And by far, your best bet to make consistent profits in the stock market is by selling naked puts. And the three reasons why naked puts are way better than vertical credit spreads are that it maximizes your premium. You don't have to spend money on that garbage, lower priced stock option. The second reason is that it's extremely easy to roll. And the third reason is that it protects you against your inherent bias of being greedy. You're not going to trade 20 naked options because your broker won't let you. But when you trade vertical credit spreads, they will let you, and then the 1 out of 10 times that it ends up in no man's land, you are going to sustain a massive loss. This is why I never recommend Robinhood. I would say maybe 10 or 15% of my students use Robinhood, the rest of them use another brokerage. But if you really want to get serious about making massive amounts of money in the stock market, you have to choose a broker that doesn't limit your flexibility. You want complete freedom, and you need to be able to trade naked options and naked puts. This is David Jaffe with beststockstrategy.com. Please like, comment, share, subscribe to this channel. If you have any questions, leave a comment below. I answer every comment. Go to beststockstrategy.com. And you can sign up now for only $19 for the first 7 days as a trial. And if you have any questions, let me know. Thank you.